Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it.
Kia ora koutou and welcome to a bonus episode of Markets, Mystics and Mayhem. There's a lot going on in financial markets and it's fantastic to get a guest speaker in. Mike Taylor, founder and chief investment officer of Pi Funds. Thank you very much for joining us. Today, we're going to discuss equity markets and everything that's going on in the world right now. We do tend to focus a lot on rates and FX. So, Mike, this is fantastic. Thank you for joining us.
I feel privileged to be on the show. Thank you.
I must state that Mike and I went to university together like a long time ago when interest rates couldn't go negative, but things have changed a bit over the last 20 years. And
They still can't go negative in New Zealand.
That's true. That's true. So two Massey University people actually make it three.
I went to Massey too, just a long time after you.
Yes. Yes. Thanks for pointing that out. But still some of the same lecturers, right?
Yeah.
So, Mike, tell us what's going on in equity markets and what worries you.
Well, we finished 2024 in a pretty euphoric state. I think equity investors anyway were sort of cheering the re-election of Donald Trump. The Trump trade was on. Markets were pushing to new highs. We got to the inauguration, 20th of January, and that's when I guess things started to unravel a little bit for equity investors.
Yeah, I found it interesting, that initial Trump trade. It was kind of similar to when he first came in 2016, right? People got excited. He's a Republican. He's pro-business, pro-growth. And they looked at the tariffs as not being as disruptive. Mm. But here we are, and things have moved quite a lot in the last couple of weeks.
Yeah, I guess people looked at the playbook and what did well last time in 2016 and just placed those same trades all over again, sort of, Russell small cap, energy, things like that. Yeah. Obviously, Tesla performed particularly well given the close association between Musk and Trump, Bitcoin as well. But yeah, things have really unraveled because I think what Trump's done is he's created this chaos and uncertainty, not just amongst the geopolitical set, but also amongst corporate CEOs and investors.
We're asked almost daily, what does Trump's policies mean for little old New Zealand? What are your thoughts on what could wash up?
We still don't actually really know what some of those policies are, other than to annoy and aggravate some of the largest trading partners, to bring them closer to, quote unquote, a deal. We don't really know what that deal is, but something that's more favorable to the US than what is currently in place. And it seems that he's prepared to put a significant amount of pressure on those trading partners, whether it be Canada, Mexico, China, or soon to be Europe, to get more favorable conditions for the US. Now, Treasury Secretary has already said that, admitted rather in the last week, that some of those tariffs and the cuts from Doge are actually, they are going to have an impact, calling it detoxing.
Yeah.
So for us, that kind of means that world growth is slowing down.
Yeah. So, Mike, with all this uncertainty that just keeps billowing out, how on earth do you actually position yourself in this market when, things are changing day to day? Like, what's the strategy here?
For an investor like us, we have to have a strategy which is kind of a barbell approach, which is that you have some high growth names or some momentum names in your portfolio, and you also have some defensives and utilities. So whilst that doesn't give you the best result at all seasons, it kind of gets smooth your returns a little bit. If you'd been just purely in a growth fund, momentum fund, in recent weeks, you would have seen a sharp correction.
Yeah, and for the everyday investor like me, because I'm watching my sharesies and it's just going down and down and down. So what's the advice for the everyday person out there?
Well, the advice for the everyday investor is always to look through the noise. Market corrections come and they go. Most people have lived through the market in COVID, and then we saw another sell-off in 2022, and yet things still continue to march on and improve. So I would expect that this situation is going to be the same thing. So don't panic, obviously.
I think that's a pretty good answer to another question that we get quite often around market disruptions is people look at their superannuation and they start freaking out a little bit. We get, people of that retirement age asking, what do I do? What do I do? In these, uncertain times. And I know what our answer is. I assume it's the same with you. What's the advice there?
Well, it all depends on when you're going to need the money. So if you are 64 and you're going to need the money next year, then you need to be in a conservative or a defensive strategy for your KiwiSaver, for example, or any other investments. But if you're 35 and you're not touching your money for another 30 years, then you want to be in the highest possible risk fund you can. And dips in the market are just opportunities to add more money.
Yeah. I mean, over the long term, those higher growth strategies, outweigh, outgun, outplay, most other defensive, portfolios.
Absolutely, they just are more volatile.
Yes.
Yeah.
And so right now, are there any assets or asset classes that you would avoid in the interim at all, or is it still just chug ahead as normal?
There's nothing that really springs to mind of areas to avoid. I mean, we've seen a fairly decent correction. I mean, if you look at property prices in New Zealand, they've come back a long way. So you wouldn't want to be avoiding that area right now. Then you look around the world and you might say, well, AI got overhyped. Maybe I should avoid stocks that are linked to that. But then again, there's a lot of investment going into AI and a lot of things, hyperscaler spending in the next 12 months is over $300 billion in the US. So doesn't feel like that's an area that's going to be pulling back anytime soon either.
Yeah.
Well, I was just going to ask you about AI, funnily enough, because is it a tech bubble, building, or do you, like you say, get invested, but then look for signs of tulips?
Tech bubble in terms of, is it kind of like a 99 2000? Not really. I mean, back then you had a whole lot of companies with no revenue on the market pushing things higher. These days, what's been driving the market higher has been the Mag 7, as we want to call them. They're real companies, $1 trillion businesses with big cash flows and lots to invest. So as I just mentioned, they're investing over $300 billion in AI and AI infrastructure ahead. Quite different to 2000, and valuations compared to 2000 are still significantly lower. So it doesn't feel like we're in that kind of risky environment. We've also probably got hopefully a supportive Fed too.
Yeah, I would agree with that. And if the Fed comes back into play, how do you see the markets, I guess, going this year? Would equity markets be higher, lower by the end of it? Is it too blanket to say equity markets? Is it like US?
Yeah, well, I think
performance.
We are seeing divergence in performance to start the year. So US is off, Europe is up, which was unexpected a few months ago. It's quite a contrarian trade, to be honest. Europe is up because of the expected or anticipated increase in fiscal spending coming from the likes of Germany, sort of just approved a 500 billion euro infrastructure and defence spending package. So that should hope to stimulate parts of Europe. So their market has performed better than the US.
Yeah, and we saw it in rate space. So German bonds, which is their government bonds, we saw a 30 basis point pop higher in their 10-year rate. I think it went from about 10.5 to 10.80. So what? It's not a big move when you think. When you look at these numbers as a whole. So yeah, a bit more growth in Europe would be really nice.
Yeah,
to
I mean,
see.
as I always say, it's not the United States of Europe.
Absolutely right.
different things, and perhaps this whirlwind that's coming out of Washington is going to unite them a little bit more.
Yeah.
In order to coordinate their fiscal spending.
Yeah.
Because definitely they've been dragging their heels for a number of years.
Yeah. I think that's a great way to sum up Europe just quietly. It's not the United States of Europe. I think it's very true. When you think of the United States of America, you could be, California could be outperforming, other parts could be underperforming. No one cares. They're all American. Same with the United States of Australia, right? People in Sydney don't care that they've been paying money to Tasmania since Federation because they're all Australians, but you're not going to get that sort of payment from Germany to Greece.
Well, no, we've seen that.
Yeah. Yeah, very much.
Hey, I thought we could actually also ask Mike tell us a bit more about Pi Funds as a fund itself, and the day-to-day stuff that goes on there, and also maybe touching on like the importance of superannuation in New Zealand, and even how we're doing as a country compared to other countries in that space.
Sure. So we are a competition to you guys. Also as a investment manager and KiwiSaver provider, business has been around 17 years ago, full 17 years, which I started. Sorry, what was the other question?
Okay, so you covered Pi Funds.
Yep.
I guess looking at the KiwiSaver landscape in New Zealand, how our superannuation kind of compares to other countries globally, and what you're sort of seeing in that space.
So we were a bit late to the superannuation, or I guess government sponsored, for want of a better word.
Very, very late compared to Australia, right?
Yeah.
In the early 90s.
And Australian contributions are now 12%, whereas most people here contribute about 6%, 3% from yourself, 3% from the employer. Some companies might do slightly more, but that's, I'm sure, probably what you get at Kiwibank. So that's not really enough to actually save for your retirement. You probably need to be saving more than 10% of your salary every year. So I have actually commented before on LinkedIn actually that we've got a massive problem with unfunded superannuation liability going forward.
Yes.
It's currently 25 billion a year, growing to 45 billion projected by 2036 before the super fund can even actually be opened up to start making payments. So it's going to be a political hot potato for the next decade, really, because where are we going to find that extra 20 billion a year?
So,
unfortunately, it's well known.
Yeah.
But politicians just won't touch it. It's in that too hard basket, and both sides of governments, in my experience, just prefer to kick that can down the road, and it's going to force a discussion, I think, within the next 10 years around retirement age and all those things that you need to do to try and stem that, lift the retirement age to 67. I'm convinced, by the time I get to that age, retirement age will be 70.
Yeah, or means tested.
And possibly means tested as well. Yeah.
But, KiwiSaver contributions are a great place to start.
Yes.
But do you think it's too late now with the gap just growing and growing, or can we still do something about this and do it meaningfully to actually get us out of this sort of rut?
Oh, well, it's never too late to start saving money.
Yeah.
So for someone who's young, then it would definitely be beneficial for them. But as far as the fiscal position and the imbalance that we've got, probably the only short-term solution is means testing.
But so just on the, you'd be in favour of compulsory or not?
KiwiSaver?
Yeah.
Oh, absolutely. Yeah.
I agree, and I think lifting those amounts. When I arrived in Australia in sort of 2002 and got my first job, there was a thing that said, "This is your salary," and it's like, "Thank you, I agree to that." Oh, and by the way, you need to pick a super fund. Super fund for what? Like, I didn't know what was going on. And it was your salary, which we agreed, and that was the discussion, and it just popped in on top. So I didn't have to make a decision other than where that money went. Whereas it's quite difficult to say, well, here's your pay. You're on 100 grand. Now I want you to decide how much you deduct from that.
Yeah.
I think it's the wrong mindset. It's the wrong way around, and it shouldn't be a decision.
Yes. So in Aussie, it's on top, right? So you 100 grand, and then you'll get another 12.
So when you talk to your employer, they just tell you what your salary is.
Is that standardised across employers?
Yeah.
The contribution.
Because it's compulsory. It's not even a discussion. And sometimes they don't even tell you where it's going. It just goes into the elected one from the business, right? I think it's a much better way of doing it, because it is hard to say how much money, can you take away. It's just flipping it on its head, nudging it in the right direction.
So, agree with that.
Yeah.
I've got another question.
Oh, go for it.
It might be a bit out of left wing. I don't know. You might not have the answer on you.
Okay.
But we had International Women's Day over the weekend, and I was actually starting to try and look at some data on the differences in balances come age of retirement for women versus men. Do you have any of that kind of data? Do you have any insights in pipelines on that kind of stuff?
It would be anecdotally. I haven't gone through and data mined our own KiwiSaver book, but I would say that balances will be lower.
Yeah.
And that's typically because females have been out of the workforce, and also we still don't have pay parity.
Yeah.
So,
no, that's what we've kind of found as well.
It's interesting to know how that gap has performed, though, in the last 10, 15 years.
Yeah, definitely.
Yeah.
Yeah,
Imagine that spread was a lot wider. Yeah, I think improving.
Yes.
That's what I'm saying. Yeah. No, it's something obviously you want to look into and try and get more data on.
Yeah, it's not easy to get the data.
No,
in New Zealand, we're not very lucky with it. So,
anyway, is what it is. I wanted to also ask you about your thoughts on crypto and gold. Just going down that rabbit hole for a moment. I've noticed you've put stuff on LinkedIn around gold.
Yeah, I mean, gold has performed particularly well in the last 12 months. Why is that? Well, a lot of central banks are actually diversifying back into gold, so they're reducing their treasury holdings because of the geopolitical concerns, and instead choosing to buy gold. So I think China's really reduced their treasury position and diversified that into gold. Central banks do come and go out of the gold market, so they're not buying there all the time. But in the last quarter in particular, they have been buying gold. So they're the main buyers to pushing up the price, as well as ETFs generally. Plus, of course, we've had inflation the last couple of years, which has prompted people to want to look at real assets like gold. So, gold's done well. It's always a good place to have a bit of a hedge within one's portfolio. Be careful, though, as there are periods or decades where gold does really underperform. When we had inflation running super low, it wasn't particularly a good performer.
Yeah, no, it didn't do too well at all. I remember buying gold in 2007 as the world started ending, and I expected it to hit 3,000. Didn't quite get there, but it performed initially, and then as you said, over that decade, the 2010s to 19 type time, it didn't. Yeah.
How close to that was it when you bought a mango plot as well? Was that around the same time?
Mango plot didn't do too well. Thanks for reminding me. My brilliant investing. Thanks.
There's a backstory behind that.
Right,
yeah.
Okay, that's for another day.
Another day.
Yeah, in crypto. Over the weekend, they've authorized a kind of strategic reserve for cryptocurrencies, listed about 5 of them, of which Bitcoin is one.
Yeah.
They have said that they're not going to add to that. They're only going to put the money they've currently, or crypto they've confiscated, into that strategic reserve. But I wouldn't be surprised if that's part of them kind of trying to manipulate the market so they can start buying at better prices. Because you can imagine if they said, hey, the US government's going to start buying Bitcoin, the price will just
boom, yeah.
So wouldn't surprise me to find out in 12 months they've been chipping away.
Yeah.
That.
Interesting. Interesting. I definitely think that crypto is going to be part of the financial fabric, from now on.
Yeah.
It's just how deep it penetrates. My view is that it just keeps going. We will see central banks Reserve Bank of New Zealand, for example, is going to have a crypto set up by 2030, ready to go. A central bank backed coin. I think it's going to be part of it, but most of the discussion then kind of moves very quickly to how do we get out of the dollar. And I'm sorry, but you can't get out of the dollar in cryptocurrencies. There's just not the liquidity or the stability in price, and simply not the liquidity is the big one.
Yeah, absolutely. It's still the reserve currency.
Yeah.
Until such time as their debt gets out of control.
Right now.
Yeah.
Yeah. There's still a lot of capacity, I think, for the US to increase debt.
Yeah.
What are your thoughts on that?
Well, for the moment, it's everyone keeps funding it.
Yeah.
And just recently, though, the spending on defence, so the spending on interest payments is larger now than spending on defence, which is supposedly a tipping point for an economy or a country, empire, sort of thing. Is that's the beginning of the end.
You go back to the Roman Empire and you see that massive inflation spike. And
Yeah, so if they had a big inflation spike now, they'd be in real trouble.
Yes. Although inflation does also help your debt metrics.
Yeah.
But it doesn't solve the
creditors,
problem.
though.
Yes, exactly. Yeah, exactly right. Anything else you wanted to?
No, I think we covered all the questions we wanted to grill Mike with.
Anything else you'd like to
Any closing
chat
remarks?
What have we missed?
I think we've covered the most for the moment. Yeah.
I'll have to have you back on in a couple of months as things maybe settle as well, and an update on everything. Because right now it's just so touch and go on and off. It's not ideal, but...
I saw a good chart actually of Trump 1.0 and Trump 2.0, and we would expect there to be some tariffs on, tariffs off, and some sort of announcement of deals in the coming months. So I can't imagine they're going to run tariffs against Canada forever, right?
Yeah. No, it's the art of the deal, right?
Yeah.
Yes.
Come in,
download it and listen to it.
Yeah, that's right. Absolutely, art of the deal. All right, well, that was fantastic. Thank you very much for joining us today. Special bonus episode where we've covered equities. We haven't talked about equities on the show before, so yeah, that was great. Thank you. Like, subscribe, follow us, and we'll see you again next week. Thank you.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.